Every single trade you make, whether it's in currencies or gold, it all boils down to one simple question. How big do you go? That decision, well, that's called your lot size. And trust me, getting it right is absolutely crucial. Today, we're going to pull back the curtain and demystify it completely. So let's start with a mind bender. How is it even possible to control $190,000 worth of gold with less than 2 grand in your account? It sounds like some kind of magic trick, right? But it's not. It's the incredible power of leverage. And the key to unlocking it all starts with understanding one simple concept: the lot. Okay, so to answer that big question, we have to start small. Let's break down the absolute building block of every single trade. What exactly is a lot? At its heart, a lot size is really just a standard unit of measurement. The best way to think about it is like buying eggs by the dozen or water by the case. It's just the market's way of standardizing trade sizes so that everybody, everywhere, is speaking the exact same language. Now, this might sound simple, but this one little choice, it's like the master control dial for your entire trade. It's what decides how much money a single price tick, a pip, is worth. It dictates how much capital you actually need to open the position, and ultimately, it defines your total potential risk and your total potential reward. It's a small decision with massive consequences. All right, first up, let's see how this plays out in the biggest market in the world, Forex. There are a few standard sizes that every currency trader absolutely needs to know. In Forex, it breaks down really nicely into three main sizes: standard, mini, and micro. A standard lot controls 100,000 units of a currency, which makes a 1 pip move worth about $10. A mini lot is exactly a tenth of that, 10,000 units, with a pip value of $1. And then you get the micro, which is a tenth of that again. See the pattern here? It's just a simple, elegant rule of 10, super easy to remember. And hey, just so you know, for those who want to get super precise, some brokers will even offer what's called a nano lot, which is just 100 units. But honestly, 99% of the time, you're going to be working with those big three: standard, mini, and micro. Okay, so that's how it works for currencies. But what happens when we start talking about something like gold? Well, the concept of a lot is exactly the same, but the thing we're actually measuring, that changes completely. And this is the absolute key difference you have to get. With Forex, a lot is all about counting units of a currency: euros, dollars, yen. But with gold, we're talking about a physical quantity: troy ounces. We've literally gone from counting digital dollars to counting ounces of a precious metal. And the great news is, the sizing follows that exact same easy-peasy logic. One standard lot of gold, that's 100 troy ounces. A mini lot? You guessed it, a tenth of that, so 10 ounces. And a micro lot is just one single ounce of gold. Simple, right? So what does this actually mean for your trading account? Well, let's break it down. If you're trading a standard lot, every tiny 1 cent tick in the price of gold means $1 gained or lost. If the price of gold moved by a full dollar, that's a $100 swing in your account. For a mini lot, that same dollar move is worth $10, and for a micro, it's worth $1. This is the direct, real-time link between the market's movement and your money. Let's put this into a real-world example to make it stick. Imagine gold has a nice little rally, right? It moves from 1900 up to 1910 an ounce. That's a $10 move. If you bought one standard lot, that's 100 ounces, you just multiply that $10 price move by your 100 ounces. The result? A cool $1,000 profit. It's really that direct. Okay, so we've got the what and the how much. We know what a lot is and how it impacts your bottom line. But that brings us full circle, right back to that question from the beginning. How on earth do you control all that value with just a small amount of cash? Well, the answer is the final piece of this puzzle: margin. Think of margin as a kind of good faith deposit. It's the money your broker asks you to put down to open a leveraged trade. Now, it's not a fee. You get it back when the trade closes. It's just a slice of your account equity that gets set aside to cover the position. And the amount you'll need depends on two things: your lot size and the leverage your broker provides. And here it is. This is the answer we've been building up to. Let's say gold is at $1,900 an ounce. A standard lot, which is 100 ounces, has a total market value of $190,000. But if your broker offers you 1 to 100 leverage, you only need to put up 1% of that as margin. And what's 1% of $190,000? It's $1,900. That is how you control a huge position with just a fraction of its total value. All right, that was a lot to take in. Let's boil it all down to the absolute key takeaways you need to remember. Number 1, lot size is your command center. It controls your risk, your reward, and how much each pip is worth. Number 2, for gold, just remember 1 standard lot equals 100 ounces. Easy. 3, a great mental shortcut, a $1 move in gold's price means a $100 swing in your account per standard lot. And finally, and I really can't stress this enough, this is the most important rule of them all. Always choose a lot size that makes sense for your account balance. That's not just a tip, that's the heart of risk management. So there you have it. You now understand the mechanics. You know the math, you know how to calculate the value, the margin, the whole shebang. But the real question is, what are you going to do with this power? How will you use this tool not just to chase profits, but to be smart, to be calculated, and to manage your risk on every single trade? Because that, right there, is the difference between being a gambler and being a trader.